debate about NSSF. And this evening, we'll be interrogating this subject on Citizen Voices. Our hashtag is Amplifying Citizen Voices. This evening, I have two distinguished guests. One is the Chief Executive Officer, NSSF, Mr. Richard Byarugaba, and I have Fred Muhumuza, who has taught at Makerere University for the last 25 years. He's also been a Chief Economic Advisor at the Finance Ministry. But first things first, Richard, you've served for 2 terms at the Provident Fund. Before we come in to debate the contentious issue of midterm access, what are some of those achievements that you can list today?
Well, first of all, I like to liken my stay to a story I always told my colleagues at the office, and I think I said it when NSSF rebranded. NSSF used to be the madman in the village. You know, every village in Uganda, there is a madman. Everybody knows about him. Nobody cares about him. He is a tattered guy. He gets food. Nobody knows how he gets the food. People sometimes give him the food. So NSSF was the sick man of all the companies in Uganda, both government and even private. So if you really, really want to know that sick man of Uganda is now a proper guy. He's had a clean shave, he's had a good shower, and he is now a respectable guy, and he's invited to the public. That is really the work that we've been able to do at the NSSF. So I really say that what we've been able to do at the NSSF is not to talk about scandals, because today everybody talks about something like midterm. Somebody talks about our benefits, somebody talks about our investments. If you go around the city, you'll see so many buildings that NSSF has been involved in. If you look at the equity market, we are the largest shareholder in Uganda in Stanbic Bank. We are the biggest shareholders in UMEME. We're the biggest shareholders in Equity Bank. In Kenya, we are the biggest shareholders in KCB. We are the biggest shareholders in within the region, in places like Safaricom. So we've done quite a lot, and that work has not only been on the investment side, but also on the processes side. I always tell people that, remember this number. When I joined the fund, it used to take us an average of 105 days to pay out our benefit to our members. Today, it takes us on average about 7 or 8 days to pay our member. So the member has benefited. Today we recruit some of the best staff in the country from all manner of employers. We attract people from the banking industry. We attract people from the audit institutions, the big four, or yeah, the big four, even the big 8, if you want to talk about it. So I would say that we've turned around the fund, definitely. It is a totally different kettle of fish. We are the first institution in this country which is largely paperless. There are a few departments, people like legal and procurement, who by law are required to keep loads of paper, but you'll find the rest of the company works paperless. And the proof of the pudding is in the eating. When COVID was announced and we had all to go home and work from home, NSSF was the only company that was able to provide services for all the services we provide, all from the comfort of our homes. We didn't have any staff during the 3 months lockdown. Of course, at the moment, we have about between 10 and 20% of staff back on premises, but certainly we can continue to do all our businesses offsite. So it's been a little journey, and if anybody wants to remember that journey, it's the madman is back.
Quite satisfying that NSSF no longer has that reputation as a den of thieves. But to come to the very contentious issue of midterm access, really this has been amplified as a result of the COVID pandemic. People are out of jobs, people have been furloughed, people have bills to pay, people have, for instance, hospital bills to pay. In essence, someone will will think about typically that saving that they have because they're in a dire situation, instead of going, for instance, to a Shylock. And yet we know that this Provident Fund, is a kind of safety net when someone is old. That's when they should access the money, when they no longer have the ability and agility to go and work and fend for their family, when they have challenges with sickness and all these kind of non-communicable diseases are striking. But you also ensure that you must safeguard against the issue of cash flows. In your view, is the glass half full or half empty in regard to this issue?
Well, I think first of all we need to look at the purpose of NSSF. I like to do a little bit of history lesson on that particular one. NSSF was created in the 80s, mid-80s to be precise. I'm told they sent a group of people to the old Soviet Union, 85, okay, 85, 86. So Soviet Union, they also went to the West and sort of were looking for a good model. At that time, most of employment was sort of covered by the area of parastatals. So parastatal was the biggest employers. And yet parastatals didn't have a pension scheme. Government had their own pension scheme, which had started in 1942 or 43. Government was looking at how could the parastatals that had been created out of the move to nationalize a lot of the companies. You remember the move to the left and that sort of thing. It created all these companies which were owned partly by government, and some of them became private companies. But they didn't know how to find a pension scheme for them, because these people, although they worked for public companies, they were not part of the traditional civil service. So a model was arrived at to create a defined contribution scheme, which basically was to then provide for old age problems, all right? In other words, if you retired, where would you get your money? And they said, what are the benefits we should provide? They suggested there were 3 benefits. The first benefit is age, right? Get to the age of 55 or 50, you're out of employment, you get your money. The second benefit was death, right? Somebody passes on, the money goes to your family and your next of kin. The third, and that's what people aren't aware of, is disease. If you get permanently incapacitated or partially incapacitated, you can then pick your money and then help yourself because you do not have a permanent source of income. So that really was the purpose, okay? And to me, that still remains the purpose. Of course, you've brought in the whole issue around COVID. How do we deal with it? COVID, in all intents and purposes, for purpose of the fund, is actually an invalidity benefit. In other words, somebody has had an incapacity to continue with their normal livelihood, and at the moment, we actually pay an invalidity benefit for members of the public who are members of the fund who actually go into hospital or into high dependency and are able to find out there. But what...
I recall you said that you'd only pay that when someone is in the intensive care unit.
No, actually, it's not only the intensive care, even high dependency. So if you are in hospital and you are constrained on the bills, because really the intention is the bills, right? Because if you're in hospital for a day or two, the bill won't be that much. But if you're in a hospital for extended period, the bill will be higher, and therefore we allow you to actually either pledge to the hospital that you'll pay from your savings to pay, or you will be able to, if you pass on sadly, to be able to get the money.
Yes, the challenge with that is Lancet Research Journal, UK Research Journal, shows that nearly 50% of those who are admitted in African hospitals in ICU died. So in essence, if you think about paying that kind of monies for people who are in that kind of situation.
Actually, let me give you the numbers because they haven't died. We've received over almost 50 applications since the pandemic started, and only 2 have sadly passed on. And even those 2 who've passed on had huge bills, and we've had actually to pay those bills through their family to the hospital in order to rate them. But the point I was trying to make is that the initial purpose of the NSSF was really about old age, okay? Certainly, we have new challenges, all right? Because in the 80s, 80% of the people who were in employment were actually working for parastatals and therefore would contribute to the NSSF. But today, we know that almost 70, 80% of people are actually in the informal sector. So they no longer actually fit that bill. So although our membership is about 2 million people, but we know that there's a population of about 19 million people who are actually in active employment. Of those, about 15 million are in actually informal employment. So effectively, they cannot join the NSSF because they are not in formal employment. So which brings me to the issues. What are the issues with those people who are in informal business? They need to save, obviously, for their medical. They need to pay for their medical, let's start with that. They need to pay for their education. They need to pay for unemployment benefit. It's a big, big problem. They also need to pay for housing. And on top of that, they need to save for their retirement. So I believe that the rules that are in the new act, they have not been talked about, but I believe that that is the biggest opportunity for us. So what will we be able to do? It will allow people who are in the informal sector to be able to save for their retirement if they wish to, but they will also be able to save for what we call mid-term benefits, right? So what are those mid-term benefits? Things like unemployment benefit, benefits for education, benefits for medical. Medical is a big deal. Actually, let me spend a little bit of time on medical. Today, the average worker who works for a reasonable institution like yours or like mine has what they call a medical scheme from an insurance company. What does it cover? It covers ear ailment. It can also cover hospitalization up to about 10 million shillings. But what do we have today? We have those diseases that actually are much, much more than that. So you'll find that your employer will only pay up to 10 million shillings. If the bill is much bigger than that, you're on your own. So the opportunity for you to save over and above what your employer gives you so that they can get a medical policy that will cover you beyond that. And I think that that is the hugest opportunity. Of course, it brings us back to mid-term access. And mid-term access, as you know, was debated in Parliament. The original bill, as you know, did not contain any mid-term access. The only mid-term access that was in the original bill was to do with voluntary contributions. In other words, savings that are not part of the 15%, which is the mandatory contributions. So, of course, when it went to Parliament, Parliament changed the rules slightly and said people who had saved for 45 years or had saved for 10 years or were 45 years old could get 20% of their money. All those people who had gone out of employment for at least 3 years and were 45 years could get 40% of their savings. Or finally, those who are disabled and are out of employment for 1 year would then get 70% of their benefits. Now, that's when the problem started. Suddenly, we've been investing all this money for the long haul, and suddenly we've got a huge drain on the cash. And that's why the whole debate was around it. Can we afford it? Can't we afford it? The truth of the matter is, in its original proposition, we couldn't afford it. That's why the president then got involved. We then went through the numbers, and then finally what has been agreed that the president has endorsed and will go back to Parliament for debate is let us allow people who have saved for 10 years and are the age of 45, let them get a one-off payment of up to 20% from their savings. And we believe that that's what we can afford.
Thank you very much. We will continue debating the question of midterm access at NSSF. What are the safeguards to ensure that cash flow issues are not disrupted? But how about those who are going through a crisis during this COVID pandemic? We'll bring in later on Dr. Fred Muhumuza, an economist and someone who really understands the intricacies of this Provident Fund. Welcome back. This is Citizen Voices, and our hashtag is Amplifying Citizen Voices. We have two distinguished guests in our studio, the Chief Executive Officer of NSSF, Mr. Richard Byarugaba, and Fred Muhumuza, an economist. To bring you into the debate, Fred, you know what is going to happen next is if this bill is passed into law and then assented to by the president, and the finance minister issues a statutory instrument, then people are then those who qualify will be able to access these funds. But we know that there's been a kind of restriction whereby, apart from the fact that one ought to be 45, they must have served for a decade. This perhaps is a kind of safety net for Mr. Byarugaba to ensure that they don't deplete the fund. Perhaps a figure, an estimate puts it at around 1 trillion shillings if they are to spend this amount. But we know very well that people typically of the Byarugaba class who earn a fairly good paycheck may not rush to access the 20%. It's the people at the low strata that could be eager to access this money. And like I said before, I mean, instead of going to a money lender and you have a bill at hospital to pay, or if you want to pay tuition for your child who is not going to school, definitely the situation is dire. It may demand that you access these funds. And yet again, it's quite not the ultimate solution in an economy which is slow, which is wobbly, which is in a kind of tailspin. If you access this 20%, how much can you do in terms of investment? But then does this not feed into the larger debate of social protection?
Yeah, thank you, Emmanuel, and thank you, Richard, because this is why he transitioned. He's comfortable with this because liquidity-wise, it's manageable. But also you have raised quite a number of other fundamental issues. The examples you're giving are actually what people are looking forward to. Can I access my 20% mid-term and go to do what? Most of the things listed are really not the core of why the saving was done, which I think is the advantage of capping who can access and how much you can access, because you don't want to lose the original objective, that this was your social security for old age. And there are these other provisions, as he said, of death or sickness. But now when people begin to say, oh, let me access so that I can pay my rent, let me access so that I can pay fees, these are things that are supposed to have been addressed by other avenues if people's normal, regular economic activities were working well. So this speaks to the challenge that we have, and the beauty with this bill is that it is not throwing out all the gates and floodgates for people to go and access the money and do the things that the money was not meant to do. Because even if you are 45, fine, we have allowed you to go and squander, like the prodigal son, if you do, only 20%. So when you reach actually 55 and you want to retire, the 80% will be there to begin off that journey. And there have been a lot of conversations on this. But for me, it speaks to a wider contextual issue that we cannot fix just by one bill or one bullet. This is not a silver bullet. And thank God, even as we are talking here, there are two related topics. This is the National Social Security Fund. You remove the word social, you're talking about national security. And the president is coming to speak to that. And in the current conversations at the global level, I've linked national security with national development. If a country can't get national development, it's going to get a lot of national security issues. So how do you link therefore the two to say how can social security resources be used for national development? Because if we can answer that question, because these are long-term funds, and we all know that in Uganda we are short of long-term funds.
That's correct.
But if we had these channeled into long-term funds, the NSSF is investing in Housing Finance Bank for housing,
Yes.
not for people to borrow to buy a maize meal, not for people to borrow to buy a border. That Housing Finance Bank is about housing. And now you can leverage this resource, get a mortgage for 20 years from from Housing Finance Bank. Now, by the time you retire at 55, you already have your house, because all the rent you have been paying to Muhum's and Emmanuel's houses, you have been owning your own house. Now, NSSF will have helped you to solve one key critical issue of old age, that you are retiring when you have a house. And that's very fundamental for most people. Where are you going to retire from? So you want to resolve these issues not by what we are now doing, but how do we find our way back to make sure National Social Security Fund resources insurance resources are channeled into long-term development. Because now the government of Uganda is going to go to NSSF to borrow. 3 years, 5 years, even if it is 10 years. You want to put this money into UDB, your development bank, which is supposed to be giving long-term funds. You ought not even to have borrowed. Just allow NSSF to buy shares in Uganda Development Bank.
Absolutely. Makes a lot of sense.
So it makes sense for you. You don't have a cost of borrowing from Richard at 15% for 10 years to go and capitalize Uganda Development. Both of these institutions belong to the Minister of Finance, literally. So through a boardroom, I just say, Mr. as government, me as government, I know I want to capitalize my Uganda Development Bank. So you call the two bosses here. The minister sits at the top of that table and makes that decision. You go to cabinet and say, let's authorize NSSF to buy shares in Uganda Development Bank. Then he will move his money there at no cost. And it begins to answer a number of questions. So I think there are a number of policy issues that we are trying to address legalistically, cosmetically, and yet the answers and the solutions are before us. So for me, national security needs to be backed up by national development, and national development requires us to tick certain key boxes. And I can list a number of things of where we need to go. You are looking at social security. There is social protection. There is social services. The conversation we have just been having here, majority of the people want to use their social security provisions for social service access, which is a core of government. You're talking about health, you're talking about education. If we could provide those effectively, budget for them, but not only just budget for them, implement and execute rightly, that you have a functioning healthcare system, that when a person aged 45 falls sick, he doesn't have to run for his social security fund. There is actually a functioning healthcare system to take care, because not many of them forget about COVID. But people are still struggling when you have to do a cesarean section. Why should you run around selling goats, cows, borrowing, fundraising for a cesarean?
At the refurbished Mulago Hospital, it
Even wherever it is.
nearly for 15 million, a cesarean goes for 15 million.
So this is social services. If those social services were covered, then you need little interventions at social protection. Now, once you've done those two, your social security goes back to its docket to take care of old age, because the sicknesses will be very few and the deaths spiking certain critical diseases, kidney failure. But now for somebody to come because they have a basic thing of malaria and what, because COVID will now be normalized. But you'll still find people fighting for midterm access, for fees, for I want to do this, for rent, I want to start a business. Surely NSSF is for starting a business, to buy a border? No. That should be another provision. So we're talking, we have very shallow financial sector markets. We have certain inconsistent service delivery systems that are not kept up, and now we're being forced to raid the Social Security Fund, which had different objectives. Because if Richard can also dig back and tell you, much as death and sickness were provided for, they used to be the minority of the cases.
Yes, that's true.
But now those are spiking.
93% of the cases is old age.
Those are spiking. And it shouldn't be, because these should be provided for, that our healthcare system works. If a person falls sick in Bukedea, he can be addressed in Bukedea or at Soroti Referral Hospital. Siamese twins the other day were separated there after Mulago sent them. I want to hear that not as a story that catches a headline, but it's the normal thing, because that's what a referral hospital should be doing. But now you can imagine those people had gone back for death of that other child. But the doctors there said, well, after all, the child is destined for death by the national referral. Let's do whatever we do. If we fail, we will have died, we will have failed trying. Now, we want those to be normal, because cesarean section should be happening at health center 4s. Normal delivery should be happening at health center 3s. Only rare cases should reach the regional referral hospitals or general hospitals and regional referrals. But now, as we have said, you want to give birth, you can't even trust the regional referral hospital in Imbarara. You are forced to go to a private facility, which is going to give you a bill of 6 million, or even 4, or even 2, and then you remember there is NSSF. Surely something is bigger, and we need to discuss that. And I am hoping in the conversations of the president, he will talk about security, but let's not forget that security and development have a linkage with each other.
Fred, just a follow-up. An individual is at the cliff. Right now they have a bill and all these kind of challenges. But you talk about the more tangible things, and NSSF has gone into that area. For instance, the investments into housing. Right now, many people are grappling with rent, and they think that the 20% could partly solve the problem if it comes in, because individuals look at the immediate challenges they are facing. But we also see, I mean, they talk about low housing units, and they are talking about $200,000. How can NSSF effectively come into that area, that there's a tangible long-term investment in housing that's modest, that can accommodate those who are saving with the Provident Fund and come into other areas of investment that have a direct benefit to those who save?
Yeah, good question. And as we said, we have now gone at operational level to fix a strategic issue. The strategic solution, as we've said, he already has shares, big shares in housing finance.
50%.
So he literally owns it.
Exactly.
So he can influence the policy. But remember,
Largest shareholder.
Remember the policy
The
of that
yes.
institution is Minister of Finance.
Yes.
Because it's a government bank. So the policy could switch and say, let housing finance live by its name. You are a housing finance. You are not Stanbic. You are not ABSA. Neither are you Centenary. You are a housing finance. So can government of Uganda, which has rightly said in the National Development Plan, housing is going to be a critical issue for us to address. Now, how do we finance it? Because we know everybody needs housing. Americans are so obsessed, to use the word, with housing, that they actually brought the global financial crisis.
To its knees.
By allowing people to access house, including those we call...
Actually, the crunch started when
it was a housing market.
Yes.
On
because
the
they even
housing
allowed
mortgages.
those who should not have
Yes.
borrowed
Yes.
to borrow and get into housing space. The people called subprime borrowers. They did not qualify to borrow, but because the economy and the country was committed to housing, and I think it's the right thing for Uganda to do. But can we do it at a policy level? Because now if the policy goes to say, let's use NSSF money for two things. Stop borrowing it to go and pay members of parliament. Stop borrowing it to go and pay salaries. Let NSSF focus on two things. Housing through housing finance, housing finance bank, and long-term financing through Uganda Development Bank. Give him those dockets. Let him come back to us with his proposal and a few other things that he will put up. Now, the best way he can save the housing of the low-income earners is over the long term through Housing Finance Bank, which gives them a mortgage of 20 years. Now, these fellows, as we have said, would not be struggling with rent because they would already be in their own house, which has been financed by a mortgage. Now, they will take leverage of Bank of Uganda's instruction to the banks and guidance to reschedule. Now, you would only be rescheduling your mortgage, which mortgage was already a long-term mortgage. So you're really tampering with the margins to say you were supposed to be bringing in 200,000 per month. Can we now make it 100,000? And then we shift your mortgage
for this
from,
period.
Yeah, for this period. Then we shift your mortgage from 17 years to 20 years. The fellow remains in the house. You have covered that problem, even without a job. But also you have given him an extra 100,000, which you have removed from the mortgage, which exactly Honorable Nabanja is giving for every lockdown. But now government will have given it perpetually to these individuals. So there are policy issues, there are strategy issues, and we can resolve them in the 7th floor of the Ministry of Finance boardroom. And after that, a cabinet paper is made. Cabinet sits either in Nakasero or sits the other side. It can be done within a month. But otherwise, if we are going to begin grappling, I always say, when you see somebody drowning in a swimming pool and you don't know how to swim, please, no matter how compassionate you are,
Don't
you are
try.
going to cause us
Don't
a
dare.
problem of 2 dead bodies. Stay alive so that investigations will begin from there. To say, was anybody there to push him in? You will be alive to tell the story. But then, can we now ring fence the swimming pool? Because we remove those errors. But when you are in panic mode, you sometimes respond impulsively and you don't solve the other problem and you can make a big problem worse.
Richard, the question many viewers out there are very eager about is, and I guess you're one of those with quite a hefty sum of money, the Provident Fund, but it's...
Saved?
Yes, saved, yes. But it may not be likely that you may want to access the 20%, but I guess you've had a couple of people asking, when shall we get the money? I believe there's most of the fund, which is about 15 trillion shillings, is a large chunk of that, nearly 80%, belongs to people of a certain category, the bank CEOs and the others. But
actually, that's not true.
That's not true.
I don't know where you're getting the numbers from.
well, you'll clarify on that.
It is citizens' voices.
Yes. But what exactly is going to happen in terms of those who qualify and should be able to access the money? Please walk us through the process of how Parliament is going to, pass this bill into law, have it assented, and then the Finance Minister perhaps will issue a statutory instrument. And then, do you have the money as we speak?
All right, that's a brilliant question. We've tried to issue out press statements, obviously. A lot of the process is out of our process, sort of our control. I would think about process and process. Anyway, so once the agreement was done with the union and Ministry of Gender and Ministry of Finance and the fund, once we agreed the policy of it will be those who've saved for 10 years and those who are 45 years old and above. Of course, if you are 50, you can already draw your money anyway. The law allows you to do that, especially if you're out of employment. So you can take 100% of your soul. Really, this is a policy aimed at those who are between 45 and 50. So once that policy was agreed, the letter will go back to the Parliament. Parliament will then send it to the committee that dealt with the bill. They will have a discussion in there on the clauses that the President is not happy with. From my recollection, they are about 4. Others are not as contentious as that one on midterm access. They will then come back to the floor of Parliament. I think there will have to be 2 sittings. One is to what they call a second reading and then a third reading. And then once it is passed in the manner that the President has directed or advised, it will then be sent back to him to accent. That process is meant to take 45 days from the time it is passed to Parliament and by the time it gets back to the President. So 45 days, and then the President will sign the bill or accent to the bill. It will then now be sent to the responsible ministry. I think that was one of the matters that was also under discussion. It's now been agreed that the responsible ministry will be the Ministry of Finance. So the Ministry of Finance will now be responsible for issuing what they call a statutory instrument. A statutory instrument has 2 purposes. One, to inform the public when the law becomes law. In other words, when it becomes operationalized. The second is how the law will be operationalized, specifically with the new new clauses that have been included. And the one specifically on midterm will go into the specifics of how long it takes to process, who will qualify. Of course, that has been provided for in the main law, but this will be in the operations. One of the things we believe we will be able to do is that there is no need for people to actually apply in person for this. Because if you think about it, there is nothing to verify, right? If Emma is 45, we know that. If Emma has saved for 10 years, we know that. We can see it from the records. So Emma will send either an email or will fill a form online. And once we've got those details, we will be able to process and send the money to Emma's account because we know Emma's account, okay? So really, at the end of the day, it will be one of the best processed benefits for us because almost it will be done paperless so that it will enable people to do that. One of the things they've put in the law is that it is a one-off. So you can apply up to 20%. So if you choose to apply only for 5%, you'll be given 5%. But you won't then come back and say, I want the other 15% which I didn't apply for, because it will just be a one-off. And the intention is obviously to allow us to plan properly for it. One of the things we also believe will happen is that you will have to give notice. So for example, because the money is not there, we hadn't planned for it, you will give notice and say, for example, within a month, maybe 2 months, even 3 months, I'll be coming for this money. Can you please prepare for it?
And how fast can the money be?
No, as soon as so long as we've put the timeline in place. So if it is, we'll process it within a week of receiving the application from the time you've told us, we will do that. I mean, we already have the processes to do so. And then we are ready to go. Our biggest worry initially at the law was that it was going to be a big chunk of the amount of money that is available to pay out. So let me give you a few numbers just to put it into context. So the fund is worth about 15 trillion shillings as I speak today. On average, we collect about 125 billion shillings a month. So that in a year, that's about 1.5 trillion shillings. Our ordinary payments are about 900 billion shillings, right? So for the other benefits apart from this new one, so if you look at what this year we'll collect, 1.5, we're going to pay out 900, so that would leave us a free cash flow of about 600 billion shillings. 900
is just a rough estimate.
It's a rough estimate,
because it doesn't mean that the CEO at Stanbic Bank is going to come.
No. The 900 relates to our ordinary payments, right? So we've sort of had a modeling which sort of estimates how much people will be drawing out this year. Last year they took out about 630 billion. It has been increasing at around the rate of about between 20 and 25%.
That's before the 20%.
That's before the 20%, yeah. So there will be the natural people who want to withdraw about 900 billion shillings. So in addition to that, then you're bringing in the 1 trillion shillings. Now, we've got other commitments. For example, this financial year, we're going to spend about 900 billion shillings on things like pension towers, which is one of our flagship projects. We've got a project in Neluboa, big project, almost 400 houses that we have to do. We've got the project of government campus, where we are going to build a government campus for the government, so that they can move all the ministries that currently don't have their properties. So there's quite a lot of needs on the cash flow, and we've got to balance all these things. So we believe that because it has now been sort of sieved out and the numbers are a lot less than what initially they were going to be, we think we can manage that, and we'll do that through managing prioritizing which payments we need to make and prioritizing which members we also need to pay.
You talk about the whole process of dialogue between the presidency and parliament, which I mean should be within, should be accepted. However, there's fear that there's the creeping hand of the state in the management of the affairs at NSSF, and that a bit also compromises the autonomy of parliament, which should be deciding the way this building should be, the way this bill should be, passed into law with very specific provisions. My question is, what is the rationale of putting the restriction of the fact that one should have served for 10 years? Because it wasn't there. The only provision was 45 years, and then we brought in the restriction that one must have served for a decade.
Yeah, I think obviously it has been a give and take, largely to do with the numbers and with the viability of the fund, because you don't want to be able to destroy the fund which has been built over the last 30, 40 years and suddenly pay all of it out. So the rationale was that let us introduce in another provision, right? So you will have noticed that for a person who is saved for 10 years and is also 45, probably their balance is a lot more than is somebody who's just began saving and is in their 30s. And also, if you really think about it, it was seen to be who might be the most disadvantaged, right? As somebody who is 45, you're probably getting into the prime of your life. and you are now beginning to prepare for, I mean, it's 5 years to 50, or it's 10 years to 55. And so you should begin to think about retirement. And a lot of the reasoning that was brought about, especially by the members of the union, was that let us provide like a safety valve for those individuals who are almost getting out of employment, or who might also not be actually employed. Because I think that there is quite a number of people who've lost their jobs, and you'll find that most people who lose their jobs at this stage are probably the older guys of society. Mm-hmm. But in effect, they've also saved slightly more. So a 20% would actually mean more to them than a guy who's saved 10 million shillings, and you're saying 20%, which is, you know, just 2 million shillings, which, as you said, might probably go to the market rather than actually going to investment. So I think all the juggling and the pulling and the giving, I believe, settled on 45 years and having saved for 10 years, which means that they will have saved a portion which can help them to either start a business or put into a business that they're already running, or something else that they might want to pay off. I know that quite a number of people are actually looking at reducing their mortgages, right? At that stage, they're thinking, oh, maybe let me pay off my mortgage, part of my mortgage, so that the burden is lower as I get into my twilight years. So it does make sense that maybe it's only 20% out of the saving that you've actually been able to make.
Fred, to bring you in, you teach development economics.
Mm-hmm.
Where does this debate of the Provident Fund fit into the larger debate of the economy? An economy that's going through a monumental crisis, dealing with the COVID pandemic, an economy now that's heavily reliant on borrowing, an economy where we're seeing less investments in the productive sectors like agriculture and the health of its people into, I mean, sometimes, I'm sorry to say, but wasteful expenditure, vehicles, travel abroad, and all these kind of things. A bloated cabinet. We have one of the largest size of parliament perhaps in the world. Where does this debate about the ability for people to save fit within that larger or broader question of the economy?
Good question, really, Emmanuel, and I think it picks up from what Richard has mentioned. We are looking at this law, quite often most people would be looking at it in the context of COVID. But remember, this is a law that is going to continue. So forget COVID and look at this law in 2030. What will these people be accessing this 20% to do at that point? They certainly may not be paying for hospital bills of the current nature that we have, because the law is going to outlive a lot of things. So rightly, who do you want to access it in 2030? What are they going to be doing? Which is where now, first of all, the factor of 45 comes in. To see, at 45, really, you are thinking of different things. You're not thinking of marrying, you're not thinking of paying maternity bills. By that time, most people would have already gotten their children into school. They would already possibly have begun to build their house, so they want to settle their mortgage or to enhance their business. So when you put in 5-10 years from now, you want to look at that context as well. Now, that answer brings in your question of what would Uganda's economy be like in 2030, so that we can give a context to what this law will be feeding into at that point in time. Now, what most people do not notice is you begin to borrow to fix current challenges and problems. But the borrowing you are doing in the case of government is 15 years, is 20 years, is 30 years. So there are a lot of borrowing decisions we are making today which will come to haunt
catch up with us
in 2030. That at that point you may realize there is not even any money left. And who knows, if government comes out there and says, hey, Richard, his equivalent at the time.
For instance, we're spending, one of the biggest budget items is doled out to paying interest for these loans.
It is paying interest. It's about 4.5 trillion plus. But also there is the rollover, the 8.5 trillion, yes, which is also part of the budget. So you put the two together, you're talking about 12.5 trillion. That is literally going to that debt management process. Now, what would that picture be in 2030. And remember, at that time, government will also be still looking for resources. Now, the two resources you can count on are two: your tax revenues and possibly
your
the
savings,
NSSF.
the savings.
So I'm looking at 2030. What would that picture be like? Because you might reach there and the person sitting in Richard's desk at that point will be held up in a tight corner where government will be saying, hey man, MD NSSF, I'm issuing out a treasury bond. I want you, and many times if he doesn't buy, most of these things he should collapse.
Yes.
So you'll be in and they will be telling you, you must buy. But remember, you have a 20% to give
to pay.
to these individuals. So unless we really begin to answer these questions to say the economy must develop whatever we are doing, the future may be very, very dicey for us. We will have traded our inheritance, like in the Bible, Jacob and Esau, for a lunch packet. And then you lose out your entire inheritance. So we need to be balancing these equations. Uganda is still having low productivity. And that's what we're talking about, that even the people saving with NSSF, how much are they putting there really? A person's salary is 800,000. So if you take 5% of 800,000, even if you collect it for a whole year, and then 10 years, now this guy qualifies for 20%, what is he coming to pick really? Does it help him? It would if the economy was developing faster and people's wages and salaries were something to write home about. Yes. But also they were doing other investments for themselves where the productivity is higher. Because right now, even if you access your 20%, what can you do that will give you a higher productivity to climb over the mountain? Because for me, this access should be saying my car is stuck, but I have a car. I want to jump start it. You don't go to 20% to buy a car. You should already be having a going business, and as we've said, it has been dented by COVID or any other thing, or you want to amplify it. So those are the questions that the development space we should be talking in. Should be giving people opportunities to invest in, and these should be viable opportunities, as I said, that they can run on their own. You don't run to NSSF to pay fees. What you do normally is paying fees. You don't run to NSSF to pay for a cesarean section or a normal delivery. That, what you already do, does that for you. And I think that's the development economic space we need to be speaking to, not for 1 year, but for the next decade and 2020.
Fred, just a follow-up question. We know that the roots of a provident fund within the edifice of a welfare state. And you've talked about a couple of things, but in essence, the most important thing is you make his job easier, Richard's job easier, if people have better savings. We've been talking about the lofty heights of middle income status. We've been talking about wealth creation. We've been talking about all these kind of things. But what exactly do we need to do to see that we can improve people's incomes? The gross national income for Ugandan citizens is about $800. And strangely, it's less than Yemen, which has been under the clutches of war and is a desert nation. What can we do to genuinely improve the figures?
I think two things. One is stop just talking about things. Do it. Where I come from in Bunyoro, they say, literally, if a bee is going to sting you, it doesn't make noise around your ear. Because then you will see it and beat it. It just comes and stings you. The one that makes noise, like most of these mosquitoes, we are able to...
It's like the barking dog.
Beat them off. So some things we don't even want to talk, just to do what you're supposed to do. If you really want to increase job opportunities, I'm looking at the data, and in some months we are losing 12,000 Ugandans going to the Middle East. 12,000.
At their most productive age.
These are at their most productive age. And remember, it's not that they are just going there to earn a living. They are going to earn some money, right? But what are they going to come here and invest in? Buy some land and build a house or pay for sick mother and a few other things. But remember, sometimes when you come back, the thing you did in your 30s, when you are here, you also built networks. You didn't just earn money when you are out there and sent it home. That's the time you interacted with Richard's son and Richard's uncle and Richard's... You build up those things that way. By the time you turn 50, you have built a trajectory of your development process. So this economy needs to create job opportunities, and we should not just talk about it. Do it. Now, what do we need to do? There are certain projects we need to rethink, and COVID has really shown us that we are a very vulnerable nation because our growth dropped from 6.5 to 3, just within 3 months. Because you are talking about last year, when we locked down in March, up to June, we had lost 3 percentage points. That's a very vulnerable economy. The World Bank had just issued a report on economic update in February, a month before we locked down, and said, no, this economy, if you are to get to middle income status by 2030, you need to be growing at 8%.
Or double-digit figures, perhaps.
Now, they were there by 2030. And remember, this report had come before COVID. So if you factor in COVID, by 2030, we possibly should be growing at 15%. 8% takes us to 2040. Now, you want to resolve those issues to say, fine, we have been doing dams. Have they answered the question? We have been doing nice roads. Have they answered the question? You have talked about wealth creation. So go back and do a post-mortem on the projects we have been running to say which of these do we need to rethink, especially now at this point of COVID. I want to see money moved out of projects that are promising us a return in 5 years. Transmission lines, they only give us a benefit in 2025. You need growth next year to revamp this economy. So you can defer some of those projects. Put your current money where you will harvest next year. Low-hanging fruits, faster maturing things. There was a time last year when we said, no, don't even give people coffee. Please, vegetables, fruits. Because we want them to plant in Feb and harvest in May. We need to revive the economy. So that's the new thinking that I think we should be taking to government in this term. And rethink the National Development Plan 3, rethink all the series of budgets to come, put them into faster yielding things, jump-starting the cars, I said. What will that
Thank
take?
you very much. Richard, quickly, we know that this bill has also other very important issues it addresses. One of those that I've read is about the issue in regard to taxes, and it's quite pleasant to hear that the people saving, if this bill becomes an act, will be paying much less tax. Please share with us.
I wish it were true. Actually, it was in the bill, but the honorable members of parliament actually removed it. So there aren't any tax incentives. Just for the public to know, what we had anticipated is that in order to help people to save a little bit more with this bill, we would first of all allow people to save over and above the 15%. But if they were to be incentivized to save over and above the 15% that they currently save, then we should grant them a tax incentive for everything that they save beyond the 15%. And we thought that would help. We also thought that if the fund did not pay tax on the income it makes, the fund would then make more money, so that at the very end, people would have more money in their accounts, but they would also have a bigger benefit at the time of retirement. And the only way you would tax them is to tax them either if they withdraw the money early at the age of 55, or if they save until the age of 60, then they would get their money tax-free. The penalty then of having to penalize people for withdrawing at the age of 55 was to ensure that the government then would get a higher tax, the member would get a higher benefit, so there would be a win-win for everybody. Government would get more tax, the member would get a bigger balance, the fund would make more income, and that would be shared both by the...
Do you think there's still an opportunity to re-engage Parliament on this very specific issue?
Yeah, we did. I mean, I appeared before the committee of Parliament that was dealing with this. I put up a very strong show. I think the Ministry of Finance also appeared. I also believe the URA also appeared. And we are all in agreement that that was the best thing to do, because they've done it in other places. I mean, this is not rocket science. It's not only started here. In the UK, in fact, they've got a huge incentive. If you withdraw your money in a lump sum, you actually pay a tax. If you withdraw your money in annuities, in other words, in small bits over the life of you don't pay a tax. So there are a lot of ways of incentivizing people to actually save or change their method of saving, and taxation is one of the best ways. Unfortunately, that's one of the clauses that has gone out. But that's not to be lost, because what has happened is that the law now will allow people to save voluntarily, yes, but to be able to then save for other things. And we are hoping that as a fund, we can come up with some of these good products to help them to save and save for a purpose. So one of the best things I always talk about is medical, right? I already talked about it. Medical needs, we need to give people an extra medical benefit because their companies are not giving them enough benefit on the medical side. We believe that people should save for unemployment. So if you are working in a company and suddenly you lose your job, you should be able to draw out 3 months' salary out of your savings to help you while you look either for another job or sort of settle into unemployment or looking for a new opportunity.
Richard, as we wrap this up, quickly, within a minute or so, talk about how you want to bring on board blue-collar workers and those who want to voluntarily save, and two, about your ambitious investment plan worth 800 billion shillings.
And the no-collar workers, those who put off their shirts and work with their buybacks.
Yeah, that's a very good one. All right. So one of the things that the law will allow us to do is to offer what they call voluntary contributions. So voluntary contribution essentially is anybody who wants to save without the law, right? In other words, they are not looking at 15%, they're not looking at the salary, they're not looking at doing it by the 15th of the month. They're looking at, I am working in a place, I can save 100,000, sorry, not 100, 10,000 shillings a week, so I will put in 10,000 shillings a week. So bring it in, we put it in an account for you, we invest the money for you. If you want to exit, you don't have to wait until you're 55, but you can exit when you are even 35 if you've saved enough to be able to save for a target. So that's one of the ways we believe that we're going to bring in the blue card. We are going to be working with associations, we are going to be working with circles, we're going to be working with investment clubs. We've already have a very strong financial literacy program which has brought in a lot of partners to be able to do that. So we believe that through that process of teaching, we will be able to attract them. And the NSSF brand has grown significantly. It has improved so much. It is guaranteed by the government of Uganda. So you don't, you are not investing in a circle or in a little investment club which will disappear after taking all the members' money, and your money will be safe. We're going to come up with those products, and we think that that will drive our members to increase, especially from the blue-collar workers. On the side of investment, very ambitious. We've got Temangalo, which we've now started. It's going to be about 100 billion shilling project, over 550 houses for low and middle income workers.
The madman is back in a good way.
The madman is back.
Yes.
If you look at Lubowa, if you look at Nsimbe, if you look at all these pieces of land that we've been able to buy, all these projects are all coming out, and I can tell the people of Uganda that within 1 or 2 years we shall have so much property on the market that you will not need to go to any other developer, and I believe that NSSF will be your partner in making sure that you have a better life.
Fred, your last word.
My last word is actually policies do matter, because the conversation is having of exempt, then tax gives a benefit to everybody. It's a policy issue, but I think unfortunately we began to discuss that a legal part.
Yes.
People did not get into the policy conversations, but also, as we've said, long-term investments to help people before they retire. Let them begin to benefit from there through policy directions, not through this operational level fixing of things. So we need to be long-term, strategic, and deploy these long-term resources to those areas, not to our consumptive needs. So policies do matter. And I think for
consumption.
For some of us who crisscross the academia and the practice, that's my key message.
Thank you very much. You've been watching Citizen Voices, and we've been debating a very contentious issue about the midterm access. We've had Mr. Richard Byarugawa, the Chief Executive Officer of NSSF, and Fred Muhumuza, an economist. Thank you very much. I've been your host, Emmanuel Mutaiziwa, and have a pleasant evening.